on. Continuing chapter 14, where we left off at PMI, private mortgage insurance. What exactly is that? We're on page 276. So anytime a buyer puts down less than 20%, at least for conventional loans, they're required to carry private mortgage insurance, because it said that the lender is risking their depositors' money, even though they're not lending it, if they require the borrower to put down less than 20%, if they lend more than 80%. So private mortgage insurance just insures the amount less than 20% that the borrower put down. So, for example, if the borrower only put 5% down and they were getting a 95% loan for the value of the property, then the PMI insurance would only cover the other 15%. That's what it insures. The balance of the 20% that they failed to put down. Any amount less than 20% that the buyer did not put down. So if they put down 5%, the insurance covers the other 15. Everybody understand that? It's not mortgage insurance for the entire loan. It's not insurance, life insurance policy in case the buyer dies that the loan is paid off. It's only for the down payment. Private mortgage insurance is like down payment insurance. If you put down less than 20%, it just covers the rest of that. And lenders are required, the law allows borrowers to drop PMI coverage when equity reaches 20%. Lenders are required by law to drop it when it reaches 22%. What does PMI insurance cover if you have 22% equity? What does PMI insurance insure? You'll get your answer by thinking of it that way. What does PMI insurance cover? What does it insure?
The amount the borrower have shortage.
The amount that they put down, the down payment requirement. They have to put some of their own money down to buy a house. They can't get it all 100% financing. So if they do, anything lent to them more than an 80% LTV, loan to value ratio, the amount less than 20% that they put down is what the insurance covers. So what does PMI insurance cover when equity reaches 22%? Come on, say it. You guys know it. Say it. It's the worst that can happen. You can be wrong. Come on, say it. Say it. It covers nothing. It only covers the amount less than 20%. That's why you're allowed to request to drop it when equity reaches 20%. But when equity reaches 22%, the law requires the lender to drop it. Why do they give them an extra 2% that they could keep charging you for insurance that covers nothing? Because values fluctuate and they may not always be on it, you know? So it's not life insurance, doesn't insure the entire loan either. FHA loans, the borrowers have to carry a mortgage insurance premium that insures the entire loan, because that's what FHA does. They don't give loans, they insure them. They insure the lender against loss for the entire loan. So the MIP insurance that a borrower pays for when they get an FHA loan insures the entire loan. I know it's the same letters just mixed up. PMI, MIP. PMI is the down payment insurance. MIP is insurance for the whole loan. All right, let's highlight it. You could also highlight BPO as a broker's price opinion and CMA as a comparative market analysis, and the information here about the BPO. So how do lenders know when your equity's over 20% or what it is? Well, they could pay for an appraisal, but why would they pay several $100s for an appraisal for that? See, in instances like this, they may order a BPO from a real estate agent to give a valuation. Everybody got that? Anybody still highlighting? Everybody got it? Okay. The FHA, the Federal Housing Administration, insures loans, but they do not make them. They don't lend
What
money.
what is the full form for MIP?
I'm sorry, let me lower my volume here. You came across a little loud there, or muffled. Go ahead.
Yeah. What is the full form for MIP?
MIP is mortgage insurance premium.
Okay, thank you.
And we're going to go over that now because that's required for FHA loans. PMI is for conventional loans when the borrower puts down less than 20%. Actually, it's for most loans when the borrower puts down less than 20%. So FHA insures loans but does not lend money. It insures the lender for the entire loan amount. It says, hey, lender, if the borrower meets our lending criteria and the property that the home that they're purchasing, because it's only for owner occupied 1 to 4 family residential properties. If the borrower and the property they're purchasing meet our lending criteria, lend this borrower your money and we will insure you against loss, so that you don't lose a penny. So 2000, let's see, the FHA 203B is the most common FHA loan. But they have many types of loans. But the FHA's 203B loan program is a fixed rate 30-year loan. It's the most common one. They have other loan programs available. They have adjustable rate mortgages. They have builders loans, for fixing properties. When you buy a house that needs work, it's not for fixing and flipping and things like that. It's not for investors. It's for owner occupants. It requires an upfront. Oh, wait, hold on a second. I skipped some stuff. It requires a low down payment of only 3.5%. So the LTV is 96.5, right? They'll loan you 96.5% of the value of the property. They have a minimum repair requirement that the house has to be in livable condition, move-in condition, not requiring extensive repairs. They got a different loan program if you want that. It requires an upfront mortgage insurance premium to be paid upfront. Yes, you have to pay a upfront mortgage insurance premium, and that's in addition to a monthly insurance premium. But it requires you to pay an upfront mortgage insurance premium. But who created this program? It's a government program, so it's charged at closing. So you have to pay it up front, or you don't have to pay it up front. You could just wrap it into the loan cost itself and then finance that upfront insurance premium. Yes, only the government can make up rules like this. You have to pay the insurance in advance. But you know what? If you don't have the money, you could finance it. So now if the borrower defaults on a loan, then they never really paid for the insurance, did they? That front insurance. I mean, only the government can think of stuff like this, politicians. All right, so the monthly MIP payment is also required, and it can be dropped only when equity reaches 78%. Okay. PMI insurance, if you recall, is only for down payment. That's all it covers. And it can be dropped when equity reaches 20% and must be dropped when equity reaches 22%. The FHA's insurance can only be dropped when you almost paid it all off and you only got 22% left to go. When you've reached 78% equity. President Obama threw in a couple additional rules just before he left office. He said, but only if after you've had the loan for at least 11 years, and only if you put at least 10% down at the time you got the loan. No wonder why he did it just before he left office. What's the minimum requirement for the down payment on an FHA loan?
20%?
3.5% down payment. Conventional loans require 20% down typically. They could require less. It depends on the lender. But FHA, what's the whole purpose of this government insured program? Makes it more affordable for buyers to get into housing. Only requires 3.5% down. So FHA insures the lender against loss. But the buyer is going to pay an insurance premium for that insurance. Make sense? So it used to be you could drop it once you've nearly paid it off, once you got 78% equity. And I think it was you could drop it after like 7 years if you manage to reach 78% equity after only 7 years. But now it's 11 years. President Obama, when he was in office, he changed it to 11 years. And then he also put in another whammy, which is a big one. He said, but that's only if you put down at least 10% when you got the loan. FHA only requires 3.5% down payment. So what do you think most people put down? 3.5%. So most don't put down 10%. So most people who get FHA loans can never drop the insurance premium on this loan. Now, why did he do that? Why did President Obama do that? Why did he put that whammy in there that you can never drop the insurance on an FHA loan unless you put at least 10% down? He knows that most people don't have the money that are getting this program to put down 10%. Oh my God. So why did he put that down as a rule now? Because he wants you to use the FHA program to get into housing, but then to get the hell off the FHA program as soon as possible. Remember, a lot of people were defaulting on those loans. Half the loans out there are FHA loans, and when the real estate market crashed in 2006, FHA was on the hook for paying back the banks all the money that they insured them, saying, we'll make sure you don't lose a penny on these loans. So now you had all these properties that the values were dropping like crazy. So you may have properties that are worth half of what the person was given a loan for to buy it from the FHA. I'm sorry, from the local lenders for these using these FHA loans. But the FHA had to insure that lender for that full amount that the house isn't worth anymore. So now the FHA forecloses on a house, sells it, and what are they getting? Half the money back, but the banks, they got everything. All right, so they got all their money back. So the maximum seller concession allowed is up to 6% of the loan amount, not the purchase price. The borrower may be able to finance some of their closing costs. What do your closing costs typically consist of? It's your impounds for the reserve account for the coming year's expenses, the taxes and the insurance. That's mostly what it is. Any or all of the down payment and closing costs can be a gift, not a loan from the buyer's relatives. They can help you with your closing costs as long as it's a gift that you do not need to pay back. Because if it was a loan, well, then they need to factor that into your debt to income ratio, and it could affect how much you could borrow. Older FHA loans before 1989 are assumable by anyone. But those after that date, they're still assumable, but the buyer has to qualify for the loan. So they got to put in an application to qualify for it. The FHA 203K, K for construction. I know that's not how you spell construction, but that's the way I remember it. K for construction. Okay. The FHA 203K, 203B is the most popular loan program that most people get, fixed rate 30-year loan. 203K, K for construction, it's technically not a construction loan, it's a rehabilitation loan, which covers extensive rehabilitation and remodeling and rehab that needs to be done to the property. So if you want to put an extension on the house, if you want to remodel the kitchen, things of that nature are covered by a FHA 203K loan. They give you two loans, one to buy the property and another to do the work for the rehabilitation. Okay, so technically it's not construction, because a construction loan is to build something where there was nothing. Okay, to build a new house. But this is a rehab loan. Okay, but I still remember it's when you do work on it. K for construction. That's when you do work on the property, right? So there's a special amendatory clause that needs to be in all FHA loans that says if the property doesn't appraise for the purchase price, the buyer can get out of the contract without penalty. Okay? So the house has to appraise for the purchase price, and we have to add that special amendatory clause to the contract. It's actually not much of a mandatory clause anymore. It's more of an addendum now, because it's a separate document altogether that we could just add to the contract when somebody's getting an FHA loan. Remember, amendments, a mandatory mend, it's something that's you fix the contract, you're at, but it's more of an addendum now because it's an additional document that's added. But either way, it's an amendatory clause. You could add it into the contract, or you could add a separate document that has that clause on it. It's already pre-printed. Now, the FHA, can anybody get an FHA loan? Okay, well, no, of course, it's got to be owner occupied. They need to qualify. But how much can they borrow for an FHA loan? Well, there are limitations on how much you could borrow depending on if it's a 1, 2, 3, or 4 family house, and dependent on what county you live in. We have some richer counties, some poorer counties. So there's actually a guide on HUD's website that shows you anywhere in the country, depending on what county you live in, how much you could borrow for a 1, 2, 3, or 4 family house. And I got the links that lead you to it here. By the way, no other school gives you this information either. Same thing with FHA loan to buy condominiums. The condo complex needs to be approved for the in order to get an FHA loan, because the FHA requires that the condo construction use the certain minimum standards of materials. The condo requires the FHA requires that 50% of the units should, at least 50% of the units or more should be owner occupied. Let me see. So I got a database search here that we could search to see FHA complexes that were already approved by the FHA, which that approval also needs to be renewed every 20 years. Okay. So if things change in that complex in the last 20 years, they also go over the financials too to make sure that the condo is stable. So they're going to look over the financials, they're going to look over the occupants, and they're going to look over the construction. But if it was already once approved for FHA, the construction is not going to be an issue, but the occupants and the financials could be. So it could be that 20 years later, the complex no longer qualifies for FHA loans. Okay. You could always, if a condo is not approved for an FHA loan, you could always get it approved by submitting an application so that they can consider it and go over all the information and then get it approved. And now, lastly, this last link here, the HUD Home Store. When used an FHA loan to buy a house and they defaulted, the FHA is going to reimburse the bank all the money. The FHA will foreclose on you. And then they'll turn the property over to HUD to sell it for them. Okay. So technically, you cannot say that an FHA foreclosed home is a foreclosure. It's a HUD home. Because FHA foreclosed, but they turned it over to HUD. So now it's just a HUD home. So you can't call it a foreclosure. Okay. Now, so let's take a look at these really quick. I'll show you these links. So the FHA loan limits by county. Let's click on that. Nope. Give me 1 second here. Uh-oh. There we go. All right, everybody see this now? This is the HUD's website. Oh, their images aren't loading for some reason. But either way, this is the HUD's website, and you can check this link here. They show you that you got to carry you got to pay for that MIP insurance, but that MIP insurance you're supposed to pay for it up front, but it can be wrapped into the loan itself. Wow, what the heck is going on with their website? Uh-oh. So you have to pay for the FHA insurance up front, the MIP, but it could be wrapped into the loan cost, and so can the closing costs, or the down payment. So it could end up that the borrower is borrowing more than 100% financing. Even though they require you to put 3.5% down, they allow you to wrap the insurance into the cost of the loan. They allow you to wrap and finance the down payment and or closing cost. And if that's the case, you could get a loan from the FHA for up to 115% of the home price. All right, so let's see. Let's look up the state, New Jersey. Let's look up. This is 2025. Let's look up the municipality's name of who got a lot of condos. Edison got a lot of condos, don't they? Let's look up Edison, New Jersey there, and submit. Is that not where we put it? county. State, county. There's Middlesex. What the hell's going on here? Oh, they're making it harder for you to search? This should be a municipality that you write down here. MSA code. Yeah. Metropolitan Statistical Area. I don't know what's going on with their thing here. Let's search Middlesex County, but when you search Middlesex County, it doesn't give you each municipality. Where you could see all the condo complexes that are approved. That's what it's not supposed to give you the statistics. It's supposed to give you. Oh, we're not searching the condos. This isn't for the condos. I clicked on the search for FHA loan limits by county. Okay, so let's look at New Jersey sorted by county. Duh. All right, sorry, that was my fault. All right, so here's the county name right here. Here's the county name right here. How much they'll loan for 1, 2, 3, or 4 family, and what the median sale price is in that county. So Atlanta County is one of the cheaper counties. The median sale price is $342,000. So for a one-family house, they'll lend you up to $500,000. This is up tremendously, by the way. Two-family house, 671, 3, 811, four-family, $1 million. But in some of the more expensive counties, like Bergen County, for a one-family house, they'll lend you $1.2 million, 1.5 for a 2, 1.8 for a 3, and 2.3 million for a 4-family. Holy crap. So you got to look up. These numbers went up tremendously last year. Wow. So you got to look up and see, depending on which county you're in. Let's see, Middlesex County is one of the more expensive counties. Union County, they're one of the more expensive counties. You want to go to Morris. New Jersey's got most of them are some of the more expensive counties, except for like some of the southwestern ones that are agricultural out in the middle of nowhere, like Salem, Warren. I'm surprised about Warren. Mercer. See, this used to be in the low 4s. Now it's 100 grand more. Gloucester, it's not quite the lowest at 524. It's 594. So Atlantic, Burlington, Camden, Cumberland. Oh, Cape May. I'm surprised Cape May's not up there with some of the most expensive. The properties that they have over there by the beach anyway are very expensive. But in Cape May, they'll only lend 667. It's still more than the average here in some of the cheaper counties. But either way, that's the guide, and that's how it works. So you got to look that up if somebody's buying a property using an FHA loan. If they're buying in one of these counties, you got to make sure you look at the guide to see that the FHA will lend up to that amount for the home that they're buying, depending where it is they're buying. Now let's look at the FHA approved condo complexes. So here is the link for that. You look up New Jersey. And then city, here we go. Here you can put in the city name. Edison, they got a lot of condos. And you can see all the approved complexes in Edison. Well, this one was once approved. You know, it's over 20 years old because it's no longer approved anymore. And somebody put in an application to get it reapproved in 2018, and they didn't submit a full package, so it was rejected. But you see, there are some FHA loans still in there. Same here. Brookview approved, expired, 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 withdrawn, rejected, expired, 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 rejected. Rejected, rejected, expired, 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 withdrawn, rejected, expired, rejected, rejected. So I don't see any condo complex in Edison that is currently FHA approved. So whoever makes an offer, they better be using a conventional loan or some other loan. Um, Unless they're going to have to submit a package and try to get the information from the association, submit it, and wait for the FHA to approve the complex. So you just basically submit that information over to the FHA through your lender. Your lender will do this to try to get the complex approved. Hell, your lender's always pushing FHA loans anyway. Let's see. All right. Hey, let's take a look at Woodbridge. Woodbridge got a lot of condos, right? Let's see if they got any in here that are approved. You guys can all see this, right? Yeah, you can. All right, here we go. Rejected, rejected, insufficient cash flow, missing documents. Like it'll tell you why it's rejected. But you could see that all these at one point had FHA loans have been approved. Expired, expired, rejected, expired, expired. Woodbridge 2, not a single complex is currently FHA approved. At least that's listed here where somebody's tried to get a loan. Yeah, this is not all of the condo complexes in Woodbridge. This is just the ones that have either previously been approved or somebody applied to get them approved. I wonder if they time out of here and they remove them from the list because I'm not seeing every condo complex here. I got a listing right now under contract that's a condo in Woodbridge, and I'm not seeing the complex listed. Unless somebody never applied there with it using an FHA loan. I don't know. Okay. And then lastly, we got the HUD Home Store. All right. You can only show HUD properties or make offers on HUD listings if you're a HUD approved agent. You need to apply for and get a NAID number. That's their national database identification number. So your broker will get an NAID number. The agent needs to take a class too, so that they could get HUD approved, and then you could submit an offer because they have specific requirements on how to make offers on these homes. They need to be done using a certain color ink and all that stuff. You could when you initially submit the offer, you submit it online through an electronic portal to get approved. And if your offer is accepted, then you need to FedEx it overnight to them, along with the check. Not a personal check, has to be certified funds that you got to send over to them for the deposit and all that stuff. So it is an interesting process. But check this out. If you're going to market a HUD home, any agent can advertise HUD homes, and the buyer's agents will get 5% commission. They'll pay up to 5% commission to a buyer's agent. Yeah, it's pretty cool, huh? But, but, so they got various HUD programs here. So if a home fails to sell at a HUD auction once or twice, then it becomes available for all of these different programs that they have, like the Good Neighbor Next Door program, which is like for teachers and firemen and police officers, where they could try to get them in some of these neighborhoods, which may be a bit run down, to try to elevate the community, by having these good people in those areas. Even though today they would probably want to stay away from those areas, otherwise they'd get harassed or whatever, because the mentality that's going on of riots and professional protesters, they want to kill cops and stuff, HUD approved nonprofits, that's new. So basically, we need housing for a lot of the illegal immigrants right now. So it used to be I could hover over any of these states and it'll show you how many homes are available currently in each state, and it would be hundreds, if not thousands, of homes. If I hover over these, I bet you the numbers are going to be very tiny. Let's take a look. Five, one, one. Currently, there's one house available in the entire state of New Jersey. Hmm. Those HUD-approved nonprofits that are used to house illegal aliens, they basically took up a bunch of this housing. Then we have dollar homes. Those dollar homes are available to also police, fire, teachers, police, firemen, teachers, and other certain approved people. You got to click on it to read more about their programs. But let's take a look. So currently, there's one home available in the entire state of New Jersey for $380,000 in Mount Holly, in Burlington. Oh, it looks like more of an apartment building. 8 bedrooms and 2.1 baths. What's this, a mansion, or is this an apartment building here? Let's take a look. Obviously needs work. Graffiti on the walls. Got some pretty big rooms there, but obviously you can see they need work. I guess this could be a rooming house or just a very big house for somebody in Burlington. $380,000. I see multiple kitchens here though. Oh, look at this big I got a pool in the backyard. At one point in time this was probably an estate, like a McMansion. But right now it looks like it's been pretty worn down and abused, and looks like it needs work. 380,000, Mount Holly. Not sure about that area. It's in Burlington County. Not far from the prison museum. Oh, that's a thing. Okay. Anyway, uh, that's the HUD home store, how it works. Okay, so when FHA homes get foreclosed on, they get turned over to HUD and they become HUD homes for sale. So those are the programs. Those links can be found in the shared Google Drive in the class links Word document, just like the others. So let me see for the other day. Let me get these links available for you. I could also send them to you right now if you like. So that you have them. We throw out there the beginning of class attendance poll, so we get everybody's, check this off. Get that out of the way. Seems like we got less people here today. All right, attendance polls out there. We just wait a minute before I close out the attendance poll. Yes, some of us have disappeared. Attendance poll, attendance poll. Wake up, attendance poll. Are you at your desk? Click that button. Otherwise, you're not at your desk. There's an attendance poll out there. Somebody click on the attendance poll. We're waiting on you, but I'm not going to wait forever. All right. We're over a minute already. That's good enough. I won't waste time on that. Okay, so FHA, let's do the highlights now. The Federal Housing Administration neither builds homes nor lends money itself. It insures the loans on real property made by approved lending institutions. So these are not loans made by the agency, but insured by it. And they require low down payment. You see, don't highlight everything, just highlight the stuff that I highlight, and then you'll have all the notes. Or I could turn back to that previous slide for the FHA where I have all the notes in one slide. Anybody want me to do that if you didn't take a snap picture of it yet? Because otherwise you're going to be, you'll still highlight this stuff, but this stuff is spread all over several pages. Here, let me back up so you can take a picture if anybody has not. And you want this as study notes. Okay, everybody get these notes?
Yes.
Okay. We have the FHA 203B. We could continue with these notes on page 276 and 277. Let me know when you got those, and I'll change the slide. Let me know when you got the notes down.
I got it.
Anybody still writing? Need a moment? Let me know. Okay. Continue highlighting here, page 277. These are additional notes. See, this is all the stuff that was all on that one slide that I had seen if you wanted to snap a picture of it.
I got it.
Okay, anybody still writing? Okay, continue highlighting here, 277 and 278. See, it's a lot of stuff for the FHA. You know, those notes are disjointed all over the place, but here you go. These are the rest of, I think this is the last of it, maybe. Is it? No, so a little bit more even after this.
I got
Everybody got it? All right. Check this out. This is the, okay, yeah, this is from page 278 under other FHA program. Okay, that was it. Okay. Check this out. The FHA 203K, K for construction or extensive rehabilitation work anyway. Here's a picture of a house around the corner from me that was using a similar type program. I'm not sure if it was the FHA program, but usually when they do things like this, it is because it's the FHA or some other rehab loan program. Where it's extensive rehabilitation and it's not for total new construction. So people do tricks like this. They tear down the entire house except for they leave one wall standing. In this case, they left the garage in this wall. This wall eventually came down. They just didn't take it down yet because the power to the house was still hooked up. They needed those lines removed first. As you could see, that wall to the house and then the garage over here. This was a house like mine, okay, like the neighboring homes, a Cape Cod style home. See that? Um, they just left the garage in that one wall. Eventually, that wall came down. They built a whole new house around that one garage. They basically dug the basement deeper and further out. They enlarged the footprint of the house, and then they built something like this. If you look at it compared to the neighboring house, it's much bigger. And this is still in the construction stage, a little bit further in the construction stage. As you can see, it has full second floor, whereas this has dormered second floor, you know, with the roof at the angle there. And then it's got the dormered roof on top of that. And they built the whole entire house around the original garage. So there was some of the original house still standing there. So in the tax records, this is like an old builder's trick. In the tax records, if this house was originally built in 1952, it's showing still built in 1952. Remodeled in 2024 or whenever it was that they did this. It was not too long ago. See, this was still under construction here. They're more, I think they're just about done over here now. All right. So look at the aerial view. This house is much bigger than the neighboring homes, which it used to be just like. That's about 3.5 times the size of this house, right? You figure it's got a full second floor, which is like equal to that full first floor here. That's 1, 2, 3. It's about 4 times the size of the house, actually, not 3. plus a full-size deep basement. That's what a extensive rehabilitation. What is extensive rehabilitation? Just remodeling the kitchen? Obviously not. Some people do this. It's a little trick. All right. Let's look at the VA loans now, the veterans loans, formerly called GI loans. You know what GI stood for? Those veteran loans, they call them VA loans now, for Veterans Administration or Veteran Department of Veterans Affairs. It was formerly called a GI loan. Actually, we used to call personnel GIs. You're a GI, you know what a GI is? General issue. Everybody got the same boots, everybody got the same uniform, everybody got the same guns, everybody got the same amount of bullets, everything was the same, you know? Now we've seen recent years our military, they start getting, join the military where you can express yourself. Look, I'm a person with mental issues, but yet I could express myself. You know, during the Biden era, we saw those kinds of commercials on TV for enrollment in the military. No wonder we were lacking by like 30% under our enrollment for military personnel. Nobody wanted to do that. Um, but now we got our military numbers back up again because we're starting to do away with all that nonsense. Join the military so that you could get gender reaffirming surgery to change your sex, you know, and then never serve a day on the battlefield. You know, that's not why we have the military. It's not supposed to be for that. It's to be a killing machine, you know. The general issue, everybody's the same. We work together as one unit. That's why it was like that. It wasn't about individualism. Anyway, that's my gripes. So, intended for veteran-owned or co-owned occupied 1 to 4 families. You must be in the military. You must be a veteran-owned or co-owner of these homes in order to buy a house. These are not for investors. These are for veterans, active duty military or veterans that meet the certain requirements. They had to have served for so long and all in order to get these benefits. Now, the VA no longer has lending limits. A lot has changed in the last couple of years in the military as far as how much they could borrow, who qualifies, and all this stuff. So the VA no longer has lending limits like the FHA does. They used to. The VA no longer has lending limits. They'll guarantee 25% of the loan amount for the property for amounts over $144,000 if the borrower defaults. So you know this part's kind of weird. You know, the VA used to have lending limits, the maximum that they'll lend you depending on which county that the property's in, just like with the FHA. Now, instead of having lending limits, they have a lending minimum of $144,000. I don't get that. But either way, therefore, no down payment is required. These could be 100% financing, depending on the lender and the borrower. But depending on the lender, the borrower must qualify for the loan based on their credit history, income, and assets. So the borrower still needs to qualify for the loan because there's no lending limit. The borrower still needs to qualify for the loan that they could afford it. There's an amendatory clause, the same one that's added for FHA loans. It says if the veteran can't get, if the property cannot appraise for the purchase price, then the veteran can get out of the contract without penalty. They do have a special name for the appraisal for VA properties. It's actually called a CRV, a Certificate of Reasonable Value. And yep, you'll need to know that for exams. What do you call the appraisal statement used for VA loan appraisals? It's named after the most popular car out there, the CRV, the Honda CRV. I say that, and sometimes people now they can't forget it. I don't know why, but sometimes that just works when I tell them to think of the Honda CRV. Well, CRV stands for Certificate of Reasonable Value. That's what we call the appraisal statement for for a VA Veteran Administration loan, the appraisal statement. Discount points, they can be paid by the seller, the buyer, or both. Uh, there's a funding application fee that the veteran needs to pay. It could be waived for disabled veterans, and National Guardsmen and reservists pay higher funding fees because we used to refer to them as weekend warriors. You know, you join the military to be on standby, but you never really do anything except for go out for training on the weekends. But these days, you know, where we had the shortage of military personnel, we have military personnel that are guardsmen and reservists that are out there sent out to war zones, and they're serving 1, 2, 3 terms they're reenlisting for. They're serving like full-time military personnel, so they should get those same benefits. The VA loans, they can be assumed by anyone. You do not need to be a military person or a veteran in order to qualify to assume or a VA loan. You need to be in the military to qualify to get a VA loan, but not to assume one, to take over someone else's loan. In order to qualify, the eligibility requirement, you have to serve 90 consecutive days of active duty during wartime, 181 days of active service during peacetime, or 6 years in the reserves or National Guard to qualify for military benefits. And here's some of the resources where I got that stuff from. And like always, if I come across a thought in my head while I'm teaching this and I think about a movie or a documentary or a comedy even, I'll write it out there. So look, check out some of these movies. Here's one called Stripes. It's a comedy. And I am surprised how many of you people who are, I mean, I feel so old calling you guys youngsters, you know. I guess I'm getting older, but, you know, I'm surprised how many people in the younger generation even have never heard of this. This movie's only from the 80s, you know, but it's a comedy. They're not going to make them like this no more, though, because they say a lot of inappropriate stuff. But either way, it is funny as hell. Got Bill Murray there, you know, from like Ghostbusters and stuff. Anyway, Stripes. That's a really good one. Or have you ever heard of this? This is actually based on a true story. The Band of Brothers. It's a HBO miniseries they created. It's about a 10-part series. If you guys have never seen it, it's about D-Day. Well, about more than that. Um, but it's a true story, World War II. Check it out. It's a very, very well filmed movie and series. Uh, it's called Band of Brothers. And I know you could get it on Netflix and all of those as well, or Cinema, if you guys have the Cinema app on your Fire Stick so that you could get all the movies without actually paying for them. Anyway, boom. Let's highlight the VA stuff now. If you want to snap a picture of this one, I'll give you I came back to this slide. I'll give you a second. You can take a screenshot of it. This is all the details that you need to know before I go to the next one where you could do the highlighting in the book. You guys wanted to snap a picture of it? I got it up there. I'll leave it up there for a couple seconds. If you miss it, just say, Vic, go back, please. All right. There you go. Here's where all the notes that you should highlight.
I got it.
Okay, anybody still highlighting or anybody need more time? Okay. So NJHMFA, that's the New Jersey Housing Mortgage Finance Agency, they offer below market interest loans with low rates with little to no down payment to qualified buyers, not to investors. So once again, a loan for owner occupants only who live in urban target areas. What's an urban area? It's a densely populated area. You apply through various local approved lenders for the various programs that they offer. They have programs for first-time buyers, for people who live where they work, people who travel to work in off-peak hours to try to help relieve the congestion on New Jersey's super busy roads. They have a special program for the police, fire, and teachers using through their pension program. And they also have interest-free loans up to $10,000 for homeowners using well water to get that filtration system. Remember when we went over that, the water filtration, and through the government, you could get interest-free loans to install it. Well, here, that's the NJHMFA, New Jersey Housing Mortgage Finance Agency, offers 0% interest loans for people to up to $10,000 to install that water filtration system. They also have loans for first-time buyers with down payment assistance. Those down payment assistance or DPA program, that loan does not need to be paid back if you live in the house for at least 5 years. If you live in it for less than 5 years, you do need to pay a portion of it back, depending on how soon you sell it, how long you stayed there. So here's some resources for you. 1-800-NJ-HOUSE is the phone number for the NJHMFA. They have their own consumer website called njhousing.gov. They have their own REO properties where they foreclose on them as well. But once again, same thing with the FHA. You probably don't find many of them here anymore right now because of the housing shortage, which was caused by the open borders. And then we have a webinar for home buyers. They've got them in all kinds of counties and such. Oh, nope, maybe not. Maybe they moved them. All right, so let's take a look at that because it took me to a 404 error, meaning the page is no longer there. So let's go to the NJ Housing website. There we go.
And Victor, I have a question real quick.
Yeah, go ahead, shoot.
Yeah, for the first homeowners, first buyer, you said down payment will be forgiven. So that's like any down payment? Like if it's like, 30%, 10%, it doesn't matter? Or there's like certain amount only?
No, they'll give the money for the down payment. You don't get to choose the down payment amount, They're not going to be like, yeah, you could come in here and offer 100% of the value of the house down payment and you don't have to pay it back. They're not doing anything like that. They're whatever the typical down payment may be, up to a certain dollar amount, that's what they'll give the loan for. Okay.
And are there any restrictions? It has to be like one family home or two family homes?
No, it could be a multifamily up to 4 family, 1 to 4 family.
Interesting.
All right, so let's see. See, here's the link right here. Here's their website. I actually got it goes nj.gov/DCA-HMFA. But in order to get here, I clicked on this link, njhousing.gov. That's their website, njhousing.gov. The webinars here aren't well, they're not there anymore. So let me go back to their website here, see if I could search for the link for their webinars, because they have these webinars that teach you all about these programs that if you don't go to in-person ones, you could see them at their webinars. Let me see. Homeowners, emergency resources, free counseling, a housing resource center. Let's see that. Search for homes. New guidance. Okay, nope, that's not the webinars either. Where are the webinars? Events. Okay, here is their real estate owned, their bank owned properties from the REOs. Let's see what they got available. They got anything available here in New Jersey? Oh yeah, they got a couple, 14 properties available. Oh, several in Red Bank and Eatontown. Cedar Knolls, Tom's River even. Look at that. Elizabeth. Okay, so they got some properties available through the NJHMFA. A little bit more than HUD does, which is surprising. So I still don't see those. Let's see, maybe on Housing Resource. Nope, that's not there. I guess those webinars, you really got to dig for them if you need to find them anymore, but I'm not seeing them here. They had those webinars for the buyers. Maybe dig through here to try to find that information on their website. Free counseling services, maybe? That's for foreclosure. I don't know. I don't know where they have the, maybe they just removed it altogether. They had webinars, all kinds of videos that you could watch about how all their programs work. Okay, so, but right now that takes you here to a 404 error page. So I don't know what good that is. So let me go remove that link from our slide there, and I'll share with you the links that I do have that work. Okay, so this last one for the webinar, that's no longer good. The bank-owned properties link, that still works. And the NJ Housing does. Let me see. Does that work? Yep, that works. All right, so I cleaned up the slideshow a bit. So I removed that last link, but these two links still do work here for you. So I will share them with you along with their phone number in the chat window. All right, so back to the slideshow. Let's take a look. I got more slides on there on info about them, but here, let's highlight the NJHMFA offers below market interest loans with low or no down payment to qualified buyers who purchase homes in urban target areas. By the way, on one of the coming up slides, one of the next slides about these programs I put together for you, you'd be surprised what a first-time home buyer is. You don't need to be a first-time home buyer to be considered a first-time home buyer. Yes, these are government programs. The first-time home buyer is defined as, I believe it is, not owning a home in 3 years. So even if you owned a home in the past, if you didn't own one in the last 3 years, you're considered a first-time home buyer again. Look at that. It's like getting your virginity back. All right, so the loans are possible on 1 to 4 family dwellings and are not available to investors. Once again, so NJHMFA, the VA, the FHA, these are loans only for owner occupants. They're not for investors. Conventional loans, they're for anybody. They could be for investors, they could be for home buyers, they could be for anybody. Oh, they got that home buyer's guide. I think that link didn't work too. I think they killed that too. Yep, they did. That was for that flyer that they had, which I still have open in another, I still have open somewhere. Oh, you know what? For that slideshow, here, this is I do have some links that that I opened the other day. Here, the NJHMFA for home buyers. You can get information on their different programs. And they got videos here that explain a little bit about it. And well, that's about it. All right. And then what else? Also got this link. Well, that's the one that their main site is to. Okay, here is that flyer that they have. It used to be interactive. Remember, I found it. So this is still that same guide for home buyers that teaches you about the home shopping process, the mortgage process, the down payment assistance programs, inspections, all that stuff. Let me see what else. We got any other resources from them? No, that's from New Jersey itself. Okay, so let me go back there. I'll update the slide for you. So I'll add this information in there. So for that flyer, I'll update that link. It's a PDF document. So this one is no longer that. It is that. Boom. That other link they have up here, that is Sue, whatever, the road home, that no longer works. The road home New Jersey, though, used to be another website link they had. Let me see if that one works. The road home. No, just point that road home NJ stuff. Just they got rid of that too. Apparently, it just points to the main website for them. Okay, so the home buyers program for the NJHMFA, their main website right here, their main page, or the one with a lot of information on it for home buyers and consumers and the videos and stuff. I'll put that one up. I'll add that to their slideshow, the last one, to this slide with the resources and links. Have that there, so you guys will have it. So done. And then the flyer. Get that. This is the NJHMFA Home Buyers Guide. Oh, sure. Say Home Buyers Brochure. It's a guide. I'll leave that there. Okay, and is there anything else? Oh, and then they got the REO, which that link I still have here, which works. Okay, so Good enough. But yeah. All right, so I obviously updated this page now. So I added the home. So this is their main website now because they eliminated some links, others they changed. So here's that home buyer video and resources page. Here's the NJHMFA Home Buyers Guide brochure, and here's the link to their bank-owned properties. So I sent you some of these. I'm not sure which ones I sent you. So what I'll do is I'll just copy them all. And I need to update these in that ClassLinks Word document as well. So in the meantime, I'll give it to you right here. That's the HMFA resources. Okay. My Zoom control. Okay, here we go. And we're back to the fire. Okay. So I updated those resources and I just sent them to you. Anyway, we did these highlights and I updated the link right there on the slide as well. Here's how that down payment assistance program works, the DPA program. You have to use it with one of their 30-year fixed rate loan programs from them. So it's first-time home buyers are defined as not owning a home in the last 3 years. Buyer's income cannot exceed 140% of the median income in the area to qualify for the loan. It's not meant for rich people. It's meant for low to moderate income. So you're allowed to make up to 140% of the average in the area. A second loan it's for a second loan of up to $15,000 for down payment assistance. And another additional 7,000 may be available for first generation home buyers for a grand total of up to $22,000 in forgivable loans. It must be combined with NJHMFA's first mortgage loan, 30-year fixed rate insured loan. So you're going to be paying mortgage insurance like you do with the FHA. The buyer used to have to take a class to qualify for this loan. I'm not sure if they still do. Learning how to do basic home repairs and how to balance a checkbook. Basically like a home ec class, but it's only one day. They want to teach you how to like replace a filter in a HVAC system, or how to replace a washer in a sink that's leaky, so that you don't have to call a professional, a plumber out, or get accountants for simple tasks that you should be able to do on your own, which would then make home ownership way more expensive than you would have thought if you got to call someone else to do simple tasks all the time. So this class would teach you how to do some of those things. I don't know if they still have that as a requirement though. Couldn't locate anything on the website that mentioned it, but it may be part of the process still. So the second loan for the DPA program is at 0% interest rate. It is a self-liquidating forgiving loan with no monthly payments if the owner lives in the house for at least 5 years. Otherwise, they must pay it back at a higher interest rate if sold any sooner. So it's 0% interest as long as you live there, But if you sell the home, yeah, I didn't see this on the website, but I know that this used to be part of how they did it anyway. That if you do sell sooner than 5 years, they do charge you interest on it, and it's a higher than the average interest. So anyway, if you live in the house for at least 5 years, you don't pay any of that second loan back for the down payment assistance. If you sell it in 4 years, you got to pay back 25%, 3 years, 50%, 2 years, 75%. And if you own it a year or less, you got to pay it all back. So here's some of the various loan programs that they have. Let me see if this link still works. It does. It just takes you to the main resource page again, but whatever. takes you back to this page for the home buyers with their different loan program details. That's fine because that's what this slide is about. About their 30-year fixed program, conventional loan, they have a first-time home buyer fixed rate loan that's government insured. They have a Homeward Bound program. I'm not sure what that's all about. They have the New Jersey Police Fire Retirement Pension System program and the Down Payment Assistance program. So they have these websites, njhousing.gov or the Road Home NJ. Where does the Road Home NJ take you? It takes you back to the home page. Okay, so where does the so it takes you here. So it doesn't take you to a separate website anymore. And if we click on njhousing.gov, okay, that takes you to the main page right here with all their links. Okay, so I'll keep both of those links up there. I guess they're shortcuts. You know, the roadhomenj.com and njhousing.gov. So, excuse me. Let me grab this Road Home NJ link since I know where it points to. So all I did is I just took this Road Home New Jersey link and I replaced this really much longer link up here, which basically that's where it takes you to. Okay. So these are those two main links for it. So njhousing.gov, that takes you to NJHMFA's main website, or the Road Home NJ, which takes you to the buyer's resource page. They have participating lenders list. Let me see if that's still active. It is. Oh, look at that. I still got that resource there at least. So you can see the NJHMFA does not lend money themselves. They have different lenders that you could get those loans through that agree to participate according to their rules. Kind of like the FHA. The FHA says, hey, we got guidelines. Local lenders lend them your money if the borrower meets our specifications. The only thing here is that the NJHMFA specifically approves certain lenders. Okay, so this is their lender list that you got to use. Let's see, they have frequently asked questions. Where does that take you? Yeah, that still works too. Okay. So that's showing you any frequently asked questions that you may have about these loan programs that they have. And even have a mortgage calculator based on your salary to see how much you could qualify for. Actually, you know what? Let's take a look at that calculator really quick since we're here. See what it does, if it's any good. Total price of the real estate, how much down payment, term, if you're paying points, closing costs. Okay, well, you'd need to know what the closing costs and all that stuff are. But hey, what the hell? It's a mortgage calculator that'll do the calculations if you're looking for all this stuff. So that's not a bad thing. So you know what? Here, I'll share that with you. Here's the link to the mortgage calculator. What the hell? Why not? It's a good resource. So let's go back to the slideshow once again. And let me add that mortgage calculator that they have. Let's see. So we got the mortgage calculator. We got the home buyer's guide, which once again, that thing, we got a shortcut to that. Let me see. Does that other one work? Nope. That just takes you to the main page again. So that's pretty useless. So let's take that PDF document and put it there. We have the water filtration system resource as well. Okay, so here's their resource. I'll give you that link directly now for the water filtration system. I gave you the loan calculator. Here's for their frequently asked page and the lenders list. I'll share that with you as well in the chat window. But all this stuff is on the slideshow, and I will just update all this stuff in the class links Word document. I'll make it myself a note for that. Update KHM FA links on Word doc. Okay. And this is from chapter 14. There we go. It's a problem when I give you all the resources. Sometimes those links change by the government, and I gotta, they're no good anymore. Okay, so here we go. So here we go. The Rural Area Homeowners Program through the REC-D. These are loans that you get from the former Farmers Home Loan Association. That's the REC-D. They give loans to people who live in areas, to farmers, people who live in including Indian reservations. Yes, our government, the United States government, is giving gives loans to Indians on reservations still. Even though it's considered a separate sovereign nation on those lands, we still are providing resources for them. So the REC-D is the Rural Economic Community Development, formerly the Farmers Home Loan Association. And they give loans for 1 to 4 family homes, not for investors, once again. But look, this resource is actually very, very good. It gives loans to people living in rural areas that are subsidized with interest rates as low as 1%. As low as 1%. Why does this keep changing the font size on me? I don't know. The low to moderate income, first time buyers, farmers, and just people living in rural areas, subsidized rates as low as 1% for modest homes, not for very expensive homes or mansions. These are for moderately priced homes in these areas. And these loans actually come directly, the funding for them does not come from a bank or separate lending institution. It comes directly from the United States Department of Agriculture, the USDA. So these are loans directly from the federal government, which can be 100% financing still. Yes, you could get 100% financing from the USDA to buy a home in a rural area with an interest rate as low as 1%. Oh yeah, you put no money down, 100% financing, 1%. And guess what? Most of Somerset is considered rural. Boom. So you'd have to check with them what are the rural areas around. But okay, so let's highlight loans funded by the USDA for rural area homes. Formerly called the Farmers Home Administration, FMHA, FMHA. Now the Rural Economic and Community Development, the REC-D. Okay, either way, it's still under the USDA. That's where the funds are coming from. The United States Department of Agriculture. Yes, the people who inspect your foods and such. And you can see they're subsidized as low as 1%. Wow. That's way below market, right? Way below market rates. Where are you going to get a 1% interest rate on a loan? Pretty neat resource I'm giving you here, huh? But I also give you the links. All right, that's it for this chapter. We are done with chapter 14. We got one more chapter of financing to go. Before we do, let's see, so we're done with this chapter. We just got to do the key terms to review. There are 2 key terms to review here. So, are you ready?
Yes.
Then let's get into it, shall we? Mortgage payments can be taken over by the next buyer. This is key terms 1. Mortgage payments can be taken over by the next buyer.
Assumable loan.
I'm sorry?
Assumable loan.
Yes, 3 is A. Highest interest rate ever allowed on a specific adjustable loan.
Ceiling.
Yes, 7 is B. The highest you could go is the ceiling, right? Repayment plan, the equivalent of 13 monthly payments per year.
Bi-weekly mortgage.
4 is C, correct. The plan with interest rate periodically changed up or down.
Adjustable rate mortgage.
Yes, 1 is D. A written estimate of value by a real estate licensee, not an appraisal. Should never call it an appraisal.
Certificate of reasonable value?
CMA.
It's a written estimate of value by a real estate licensee. How do
CMA.
people value properties? Yes, it's a CMA. Or what's another valuation that we do as well? It's not on this list. That we usually do it for lenders in exchange for a fee. It's a BPO. Remember, so we do CMAs, they're usually complimentary. We do them for our clients, or BPOs we usually do for lenders in exchange for a fee. So next to CMA, put a slash and write BPO as well, because technically they're both written estimates of value by real estate licensees, right? So technically that's right. So let's write BPO next to CMA, so they're both there. So 8 is E. Okay, repayment plan of principal and interest that gradually reduces debt. A repayment plan of principal and interest gradually reducing debt.
Amortized loan.
It is an amortized loan, correct. It kills off the debt, right? Because that's what amortized means, to kill off, right? So it kills off the debt. So 2 is F, as in Frank. A percentage beyond which interest rate cannot be raised at the adjustment period.
Cap.
6 is G. Payment of extra points in return for a lower interest rate.
Buy down?
The buy down, 5 is H. The difference between the current value and money owed.
Equity.
Equity, 10 is I. A VA appraisal statement.
Certificate of reasonable value.
Yes, 9 is J, certificate of reasonable value. I have to do the key terms too. A loan guaranteed by the federal government.
VA mortgage.
A VA mortgage. They guarantee 25% of the veteran's loan, right? Protection for lender on a low down payment conventional mortgage. What do we call that protection for the lender when the borrower is putting down a low down payment, less than 20%?
Private mortgage insurance.
PMI, private mortgage insurance. 7 is B. Mortgage payment, including amortization, interest, and certain expenses.
PITI.
Yeah, it's a pity loan, which also is known as a budget loan. So if you want to write next to pity, budget loan. 5 is C. Percentage of property's value that may be borrowed.
Interest?
No, percentage of the property's value that can be borrowed. The lender will loan you a percentage of the property's value.
Point.
The LTV, the loan to value ratio,
Okay.
that's the percentage, they'll lend you 90% of the appraised value, you got a 90% LTV, okay? 80% LTV, FHA loan, 96.5% LTV, okay? So 4 is D, the loan to value ratio. Lender agrees to hold the interest rate for a certain period of time.
Rate lock.
It's a rate lock. Look at that. They still got the question here, but they removed it totally, the paragraph that explains it from the book. 8 is E. A 1% of the loan amount charged as an upfront interest when a loan is made.
Point?
It is a point. Low down payment insured mortgage loan.
FHA 203B.
Correct. One is G, as in Joel. Mortgage with payments of interest only. What do we call an interest only loan?
Straight loan.
A straight loan. 9 is H. A charge for the use of other people's money.
Interest.
Interest, right? That's the rent we pay, right? For privilege of using other people's money. 3 is I. A guide to national mortgage trends used for adjustable rate mortgages to determine whether
Index.
rates will go up or down.
Index.
It's tied to some sort of an index, which the common index is the 1-year US Treasury bill. So 2 is J. And that is correct. And that concludes chapter 14.